Good afternoon, everyone. I'm Sophie Richard, Counsel in the Knowledge Management Tax team of Arendt. Thank you for joining us today for discussions on real estate fund structuring and market trend updates. For these discussions, we have two speakers. Vincent Mahler, who is a partner in our tax practice. He has more than 15 years of experience. He advises on national and international issues of real estate, private equity, debt structures, as well as financial transactions, with a focus on transactions relating to French investments and investors. And we have Alexandra Clouté, who is a counsel in the tax law practice of Arendt. She has more than 10 years of experience. She advises on national and international issues of private equity, debt and real estate funds. And she also focuses on FATCA, FIORES and DAXIS issues. Thank you. Before we get started, just a few words on housekeeping rules. So first, in the WebEx, you have a Q&A section where you can ask your questions. And if we have still some time at the end, then we will review your questions and answer. And also, we have a chat box for any technical issues. So now, Vincent, Alexandra, I'm very happy that you will share with us your views. First, on the structuring of Luxembourg funds, what are the key updates and trends? And also, what are the trends in certain investment jurisdictions?
Thank you, Sophie, and welcome again to everyone. So let's start, I would say, with the basic, one of the plain vanilla structure we see and we put in place in the past regarding real estate fund structuring. It's a typical structure combining a fund as a CSP, a partnership in Luxembourg, and a master holding company underneath, forming together what we call the investment fund platform. This structure have many different merits in the past, most notably to ensure a significant level of substance at the master Luxco level by having a pooling of the different investment, by centralizing the different functions, financing function, cash pooling functions, and this was something robust in order to, from a substance perspective, defend the Luxembourg substance on an overall basis. The triangle, and to keep that in mind, the triangle would include as well a manager, and of course, if you have your manager, your IFM in Luxembourg, you have that, I would say, in brackets, perfect triangle between the fund, the manager, and the holding platform that will drive the different investment. We see that for the different investment, we have an intermediate Luxembourg company, something generally needed for non-tax reasons, for requirements, security package requirements in terms of bank financing, also to ensure a proper cash repatriation in a very efficient way and a simplified way. So that structure is still works, but we see that some developments in the international tax environment led to somewhat generate discussion and envisage different options in order to accommodate certain constraints. Just one remark regarding that structure in terms of ETAT 3, you heard about it in the beginning of the week. ETAT 3, it's a directive from the EU proposal of directive in order to tackle the shell companies. We will see how it goes because it's currently discussed and we don't have the final proposal, but typically in that configuration, having a lot of substance at the master Luxco level will help you to play a holding exemption or a domestic exemption if we keep the proposal as it stands, or even if we have some adjustments, the criteria of substance the substance laid at the level of master holdco should help and try to help to avoid, I would say, the negative aspects in that respect, but a case-by-case analysis has to be done, of course. There are two things that might generate some discussion around other alternatives in order to structure the real estate fund. The first element is we have more and more scrutiny in the source country regarding the beneficial ownership position of the Luxembourg intermediate company. It might lead to discussion around applying exemption on dividend distribution or exemption on interest payment about withholding tax if you have it in the source country. The second element relates to the fact that efficient structure in certain countries now is more via real estate fund or real estate collective investment vehicle rather than using a standard propco. Which, and typically this is the case for France, we will see that later, which put on the table for discussion the use of a master Luxco or not. There is another element which is key today in order to structure and to determine what will be the appropriate structure for a real estate fund. It's ETA 2, so the rule around the anti-hybrid rules, and not only in Luxembourg, but also the implication from a source country perspective. And this is the different point that Alexandra will focus on now. Alexandra?
Now?
Yes. We can get back to that. It's a summary of the. I mean, we can say a few words on this. It's a summary of the main feature of the SCSP. Well, non-feature, it's for your knowledge, I would say. SCSP, flexible contractual vehicle, the regularly used in Luxembourg. From a tax standpoint, the key element is that you have to monitor the ETA 2 issues with the SCSP. Because it's a transparent vehicle from a Luxembourg perspective, and it could be a different approach in either the source country, but also at the investor level. While if you use a fund as an opaque entity, you don't have this ETA 2 monitoring to do. You can look at the different features. It's pretty well known, and so I think it's good to focus on
Yes.
the ETA 2 analysis.
Thank you. So if the fund is structured indeed as a Luxembourg SCSP, a Luxembourg SCSP is in principle not subject to corporate income tax and is considered as a tax transparent entity in Luxembourg. However, for some other jurisdictions, other countries may not see the SCSP as a tax transparent, but rather as a tax opaque entity. And this would trigger the SCSP as a hybrid entity for having both the features of tax transparency and tax opaque, depending on the point of view. And this is what ETA 2 is tackling. In terms of tax consequences, when you are in presence of a hybrid entity, you may trigger the application of the reverse hybrid rules, would lead to the application of the corporate income tax at the level of the SCSP, or for the investment fund platform, you may trigger a denial of interest deduction. So in the fund formation, at closing, it's really key that the investors complete properly their ETA 2 questionnaire, because this would be really helpful to assess the ETA 2 position of the fund and the investment fund platform. But to trigger an ETA 2 tax consequences, and especially in the reverse hybrid situation that is depicted on the slide, a few different conditions need also to be met. So you need to have a hybrid entity, but also you need to have an associated enterprise. And in the context of a hybrid entity, an associated enterprise is an investor holding 50% of the partnership, either on a standalone basis or while acting together with other investors. In our case, in the example, we have investor A1, A2, A3 being part of the same group, And together they present 80% of participation in the SESP. So we can consider that investor A from 1, 2, and 3 being associated enterprise. So we move to the next condition to trigger the reverse hybrid rules is we need among this associated enterprise 50% of this investor considering the SESP as a tax opaque entity, and this is a new clarification from the budget law, that these investors are also taxable investors in a nutshell. So when I look back at my associated enterprise on the chart, I have investor A1 and A2 being taxable entities and considering the SESP as tax opaque. So technically, I would have the fund becoming subject to corporate income tax for 70% on its net profit. However, there is a carve-out in the reverse hybrid rules for collective investment vehicle. So an investment fund that is widely held, which holds a diversified portfolio of security and for which there's investor protection, there is normally this fund does not become subject to the reverse hybrid rule and is not subject to corporate income tax, even if the conditions are met. So the point of structuring in ATAD 2 is not really on the reverse hybrid rules that would be more relevant for continuation fund where you would have only one asset, or for co-investment / funds of fund where you would not be widely held. Moving to the next slide, and this is really in terms of real estate investment fund platform where the ATAD 2 consideration kicks in. It's regarding the denial of interest deduction. Denial of interest deduction can happen at two levels to simplify the thing. It can happen at the level of the master Luxco or at the level of the property company under the imported mismatch rule. In a typical fund structure, where if I look from a Luxembourg perspective, I'm asking myself, is master Luxco entitled to interest deduction from its back-to-back? And in a typical fund structure, as said, I do not have normally associated enterprise holding 50% of the fund on a standalone or acting together basis. However, based on our experience, the property companies or the jurisdiction of the investment where the property is located may not interpret the notion of acting together the same way as Luxembourg. And they may, for some jurisdiction, for example, it's the case for France, they may consider that all investors are acting together because of the presence of the general partner. So in that context, if there are some investors in the fund starting from 1%, considering the SESP as a tax opaque and being technically taxable investor, there would be a pro rata denial of interest deduction. And in our example, we can see that investor B, that is taxable, and sees the SESP as tax opaque. The same for investor E, that is located in France. It would trigger an 18% denial of interest deduction. So to increase the tax efficiency of the structure, and in terms of the imported mismatch are quite burdensome for managers to monitor on an ongoing basis and under each jurisdiction, we can find some other alternatives. The two main options would be to park all ATAD 2 harmful investor in a corporate feeder. Corporate feeder would have the status of a RIFE to be an exempt entity, and because of this corporate status, there would not be a denial of introduction and no hybridity. We can also have a second option, and its feasibility will depend as well on the US investor status or not present in the investment structure. It's simply to have the fund structured as a corporation. So corporation with the regime of a RIFE or a SIF, really depending on the regulatory needs. A SIF, we'll see, may be relevant for some other investments. IRIFE may be depending on a case-by-case basis, and this is mostly relevant for France.
Maybe
yes.
One comment on that last slide. Thank you, Alexandra. It's important to keep in mind and to have in mind that choosing between the different options is really an arbitrage to make depending on the constraints of the typical situation. Because if we look, if we start with the propco, for example, the first question is, do we have an interest deduction capacity between the fund and the propco, so on the shareholder loan scheme, compared to the bank loan that will probably be in the structure. The second element is also to think about the position of the master Luxco, because the master Luxco is, I would say, more defendable, or it's more intuitive to have it in a SCSP configuration with a fund and a SCSP. So because of the transparency of the fund, while when we have a RIFE SIF as an opaque fund, it's a bit less intuitive. We have many different reasons to defend this, but it's a bit less intuitive, and that element have to be analyzed together in order to determine what could be the right arbitrage. We have experiences as well where we don't really have an issue at the end of the day from an ETA 2 standpoint to have an SCSP. We have a monitoring to do in order to determine the right allocation, but at the end of the day, in terms of I would say tax amount at stake or interest deduction capacity at stake is quite low, but some managers just do not want to invest time in order to do that monitoring and prefer having a solution which completely park the ETA 2 question on the side. So it's that different element put together have to be retained in order to do the choice between the different options.
Yes, thank you for highlighting this. On the next part of the presentation, we will look at the different updates from a country perspective, and I will start with the United Kingdom. On the 7th of June of last year, the Luxembourg and the United Kingdom has signed the long-awaited new double tax treaty to replace the treaty that was currently existing from the mid-60s. This new double tax treaty is just an alignment with the OECD standards and will introduce, notably for real estate investment fund platform, land property rich clause for capital gains. In terms of the current double tax treaty, currently gives the taxing rights in the context of a disposal of shares to the sellers, to the jurisdiction of the seller. With the new double tax treaty, this is no longer an absolute right. It means that where there's the disposal of shares of a company holding real estate assets, likely in the United Kingdom, the taxing right will be now allocated to the United Kingdom. What does it mean to be a land-rich company? You need to derive your value at least for 50% directly or indirectly from UK land. In terms, this revision of the double tax treaty is also an echo from the domestic revision in the United Kingdom, which implies taxation for non-residents in the context of a direct or indirect sale of shares of a land-rich company. In terms of transaction, this section on capital gain will be triggered either on the transfer of shares, but also in terms of liquidation or in terms of merger or demerger. The timing for the entry into force of the new double tax treaty will likely come as from the 1st of January 2024, since it's currently under discussion and approved by the government last week, I think. There is no grandfathered rule, so it means that any transaction occurring after this entry into force will fall into the scope of this capital gain treatment. as a more modern as a more uprising alternative, I think we will see more and more the rate co structures in the United Kingdom appearing. So the rate co cannot be a structure to plug it below a master holding company, because it will trigger taxation at the level of the master holding company. So this is typically a situation where you would find the rate company being parked alongside the master holding company, meaning below the SCSP, below the fund. The rate co is also gaining new interest in the United Kingdom, because they have also made new revised conditions that are lighter for the application of the rate regime. So the main question is, what is a rate company in the United Kingdom? It is a UK tax company which benefits from a special tax regime. It can own UK land either directly or indirectly via other subsidiaries. And both the rate co and its subsidiary will be exempt on income and gain deriving from the UK land. So this is a very attractive regime. There is a but, of course, taxation occurs but upon distribution of said exempt income to the shareholder. So the rate co making a distribution to the SCSP will likely be subject to a 20% withholding tax. The SCSP, being tax transparent, cannot claim any treaty benefit. So it will be for the investors to claim to prepare a refund claim to HMRC to try to have, depending on their situation and status, a reduce or an exemption under a double tax treaty. In that context, I think that's what is the most relevance of the rate co structure, and I think it will be an uprising for the future.
Thank you, Alexandra. An update now on the French market and what we see. We're gonna discuss a bit about the French OPCI SPICAF configuration and the relation with the Luxembourg fund. But just maybe one step back before. Of course, all the listed investments in France are not structured that way. We could have, in certain situations, the use of a standard SPV, standard PropCo. The differentiator relates to the type of assets, the investment policy strategy, and also, I would say, an appraisal of the cost, because a French OPCI, it's a fund, it's a real estate vehicle, compared to a standard PropCo, which is, of course, less expensive. And at the end of the day, in a French PropCo, not a French NCI like this, but a standard opaque vehicle, you have, of course, the 25% corporate tax burden, but you can optimize the position of the vehicle with debt financing, and so at the end of the day, there is really an appraisal to do. Anyhow, we have clearly that situation on a regular basis. So investment structure via a French OPCI with a direct shareholding via a French SCI. So the French part of that structure, we achieve a complete exemption on that. The question you know very well, it's not new. Come from the revamp of the double tax treaty between France and Luxembourg, and the question around the distribution of proceeds from a French OPCI to a Luxembourg fund. First, of course, now that structure does not work with if you interpose a holding company in Luxembourg. It does not work well, because you end up with a situation where we have more than 30% of taxation, so it's not in line with what is accepted by the client on the market. The question around the distribution is to benefit from the 15% withholding tax which is the reduced rate in the double tax treaty. And the question is, can we consider a fund from a French perspective as a comparable vehicle, comparable fund vehicle in France? And you remember probably the fact that there are a lot of discussion around this. The criteria are quite clear, and from a technical standpoint, solid arguments exist in order to defend that a RAIF, a CIF, of course, a reserve alternative investment fund, and even a NAIF could fit within that condition. It took a lot of time in order to define a position, because the first discussion with the French authorities, there was a situation where the tax authorities asked the AMF, so the fund regulator, to take a position of the comparability, and there was some inefficiency in dealing with that questions. Then, from a tax standpoint in France, that kind of situation where that was by the non-resident tax office, and for a certain period of time, there was no articulated and consistent approach, and it was more on a case-by-case basis to analyze if a Luxembourg fund could be assimilated to a comparable fund vehicle in France. Now, all that question are driven via the direction in Paris, and there is a dedicated service in order to do the analysis of the comparability, which is at the end of the day more a legal analysis rather than a tax analysis. And based on the exchanges we have with our best friend in France, clearly we see coming on a more regular basis positive answer on the comparability in a ruling context for a RAIF, for reserve alternative investment fund, and for NAIF it should work as well. This is something that is, our French colleagues are very cautious about this, and it's clearly completely understandable, because it's a one-to-one approach. If you want to secure the position, you have to go to the tax authorities in order to get a ruling. But the switch from dealing with that question at the non-resident office level to a more centralized approach really goes in the right direction. So it's really a good news, and probably in the coming years we're going to have more and more positive feedback on that configuration, which, to just make the link with the initial remark I made, it's you see in that configuration, it's clearly in the past fund plus master holdco. Now we have in France this option using a French PCI, but we know that it does not work with a master holdco. So this is a point to take into account when discussing the option in structuring the fund. Do you anticipate using a French PCI in order, if you are in the French market, in order to structure your French assets, or due to the investment policy, the size of your investment, or you rather consider using standard propco, and that depending on the answer, the final setup in Luxembourg could change. So it's important to have that in mind when discussing and I would say designing the Luxembourg platform. Another example, very interesting, it's in Portugal. So we see on a regular basis investment structure via real estate vehicle. It's something used on a more regular basis now, and we have a configuration with the double tax treaty between Luxembourg and Portugal that is very efficient. So a rake in Portugal remains a taxable entity and benefit from an objective exemption on real estate income. And this is a starting point. The second element within the context of the double tax treaty is that from the exclusive right of taxation is allocated to Portugal because the double tax treaty qualified the income coming from the rake as real estate income. And we have on the exits a withholding tax of 10% on the distribution. All that elements together, and on the top of that, of course, by having a tax resident certificates in Portugal, we can apply at the Lux Holdco level a participation exemption configuration on dividend, not based on the directive, but based on the double tax treaty, which leads to an efficient structure, because at the end of the day we have I mean, if you have only real estate income in the vehicle in Portugal, we should end up with a 10% taxation, which is again completely in line with the market, and it's a very important point as well to have in mind. We are not targeting, and our clients are not targeting a zero tax situation. It's to have a configuration that helps to be in the market trend and what is acceptable in terms of effective tax rate in a pan-European fund like this. And 10%, 15%, it's based on experience and what we heard, and the feedback from the market is something which today is completely integrated by the client, the business plan, and the projection.
And for the last slide and the last structure, I wanted to talk about Italy. So differently than Portugal, we see in Italy also a real estate investment fund, but the characteristics are a bit different than the Portuguese one in terms of tax treatment from a Luxembourg tax perspective. So a real estate investment fund is a closed-ended undertaking for collective investment without the legal personality, and it will be managed by a management company. The management company for this fund can be either Italian, but based on our experience, we also see that, for example, the Luxembourg AFM managing the Luxembourg fund would also work for the management of this Italian RAIF. The good thing about the Italian RAIF is that it is a vehicle that is exempt from corporate income tax in Italy, as well as the regional tax on productive activities. The proceeds distributed by the RAIF to the Luxembourg holding company should also qualify for an Italian withholding tax exemption. And at the level of the Luxembourg holding company, we do not see, contrary to Portugal with the rake, or contrary to the UK rate, we do not see the RAIF as a corporation, but we see the RAIF as a tax transparent entity, meaning that Lux Holdco is considered as holding directly the real estate assets in Italy. So leading to an exemption of tax in Luxembourg, of the taxing rights, with reallocation of the taxing right in Italy. This is quite a very efficient structure as well for the Italian market, and it is also approved by the Italian tax authorities in different rulings. So it is a structure that works in terms of efficiency for a specific type of investment, whether it's to lease or to sale. I think 1 minute is left. This is the end of the presentation. Sophie, Vincent, thank you very much for your time. I thank everyone who is also connected. Maybe it's a time for a question, or maybe later, depending on the...
Yeah, we have a few questions, but well, as we are running
you have to pick up the most interesting ones. So
Okay. Do you think we still have time? Do you want to take one, or?
Yeah, of course.
Okay. So there is one on the UK non-resident capital gain tax. How would you manage UK 75% property rich and be able to make an exemption election?
That's a tough one for, I would say, for a UK advisor mostly. But two things are to be distinguished. This 75 property rich threshold is indeed based on the UK domestic tax law. The tax treaty now allocates the taxing rights to the United Kingdom. So in terms of alternative structures to get the exemption, we see UK right, we see also we can have structuring via G-put, we see other direct holding via the SCSP. There are a few other tricks in the leaves to try to make UK investments efficient.
Yeah, but it would be a pleasure for us to have a dedicated discussion with our best friend in the UK, with our UK colleagues, in order to go deeper in the detail, of course, if they are appetite for that.
Sure, thank you. So I guess we should now close the session. Thank you very much for joining us today. Maybe just go to the last slide to present, tomorrow we still have one session on VAT, so do not miss this last session. Thank you for joining. Bye-bye.
Thank you, bye-bye.
Thank you. Thank you.